hard.
How many people are already in? Because I can't see.
Yeah, I've seen quite a few people are already logged in. Hi, everyone. Please wait for a few minutes while we wait for a few more people to join us. Yeah, I see Vivek is here. Some few other people. Tell us where you're located. All right. So we'll start in another few minutes.
You should just announce where people come from. That would be fun.
Yeah. Any tickers? Let's see if I see any chat. Oh, we got, yeah. Hey, Vivek, he's in San Jose, California. I know Eddie Wong is in Hong Kong. Hello.
Oh, wow.
Hong Kong?
This is not just just not just coast to coast. Now it's country to country.
That's right.
Hi, Sue. Yeah, love people raise hands.
All right, we'll start in another minute. Yeah, I'm busy trying to broadcast this to the Coast-to-Coast group. All right, well, I think we probably should get started. What do you think?
Yep. Yeah, I think we should.
All right. Well, looks like we also have Jin Shu from New Jersey, East Brunswick. Hello. Hello, East Coast. All right, so why don't we get going here? So, hi everybody, and welcome to our 17th. Oh God, so many way to go, Coast to Coast Real Estate Meetup. I'm excited to have our partner Yan Yan to talk about an investing strategy. I think that is more relevant today for passive investors because we're in a huge, really hot market. But before we begin, let me give a quick introduction about Coast to Coast Real Estate Meetup. But I think most people on this call knew about us already. And Coast to Coast is a community of real estate investors with all levels of experience. And we believe everyone is an expert in something and we can come together to network and learn. So in the past, we interviewed experts like Jonathan Tumbley or Kyle Mitchell and other heavyweights in the industry. And our team also gave updates on the state of the economy and the market. And I think Yan has also talked about asset allocation, investing out of state, which are part of this Real Estate Fundamental series designed for a passive investor. So why don't we go ahead? Yep, housekeeping and disclaimer. Yep, gotta throw this up here. This presentation is for education only, and there is risk in real estate investing, and always do your own due diligence. Also, if kind of housekeeping, if you have any questions, please use the Q&A box, and we will go through those questions at the end. And we also want to have this presentation within an hour, and we'll have the hard stop at an hour 15 minutes. So with that, why don't we keep going to the next slide. This is a quick introduction. I'm Henry Yun from Seattle. I'm married with 2 kids, and I have an engineering background, work as a project manager in a Fortune 500 company. This is about 9 years ago, caught the real estate bug and founded a company with my partners. And our team renovated over 50 projects and built 5 single-family homes. We are still managing our rental portfolio, but we are also, right now, my focus is in quality cash flowing assets, so especially on multifamily. is because people have to live somewhere. So you don't need an office, or not everyone can afford a house, but you all kind of need a place to live. So that's why I like it so much, and I also like the cash flow to supplement my W-2 and the tax benefit. But there are also other interesting real estate assets as we are going to be learning today and in future webinars. So with that, why don't you give a quick introduction?
Hello, everyone. My name is Yan. I'm a risk manager by trade. I work for a large quantitative hedge fund, specialized in asset allocation, risk management, and data-driven investing. I found those skills are very easy to be applied to real estate investing. I actively grow my passive portfolio. So my goal is to live all those cash flow from the passive portfolio and travel around the world. My mantra is that you need to take calculated risk because you only live once. I'm currently working with Hunter Thompson on the next project, which will be revealed in late March or early April. We are working on the legal docs. So hopefully I can talk to you guys about these opportunities. So a little bit about Sharpe Investor Group. So Sharpe, spelled as S-H-A-R-P-E, Sharpe ratio measures the risk reward. So the risk adjusted returns. We want to find the highest point, which is this one. And here are some screenshots of our newsletters. So you can find us on our website /blog. And you will also go to a website /contact and schedule a 30-minute call with me. Okay, today's agenda, we have a full agenda. Within an hour, we will cover what are the challenges, things that you are facing as individual investors in today's environment. So what are your options? What are the pros and cons of different solutions? And then we will cover a new way to solve this problem. And lastly, we will have a Q&A session. So the goal today is to understand the challenges and understand your options, and then understand how do they compare versus the new way. The conclusion, I try to convey a message that this new way of investing might add value to you when you compare to your other options. So let's start with challenges. Let's start reviewing 2020. This part will be quick because everybody knows what happened. So we will just cover 5 numbers: COVID, GDP, unemployment, and then performance of different asset class and home sales. Okay, so this is really cool picture. Wait. Boom. Okay, so this is what happened. All right, so how much it cost for COVID? So just put things into perspective. This is how much COVID cost. That's 16 trillion with a T. And how much it cost for post-911 wars? That's 6.4 trillion. So it costs more than twice of the war. That's how much the economy cost. Okay, when we look at the job claims, there are 2 numbers. One, the blue one is the initial job claim, jobless claim. The other one is the continuous, meaning that, okay, they still cannot find a job. They still need to claim this money. So how much we're talking about? At some point, it reached 24 million, 25 million. And this is much, much higher than what happened in 2008. Okay, so how about we look at the change of GDP versus housing price. So the blue line is the housing price in the major, like 20 major cities across the country. And then the red line is the annual change of GDP. what we can see, a couple of observations. First, they always move together. You see, when it goes up, it goes down, they all move together. Although we do see the blue line is more volatile than the red line. What does that mean? That means the housing price always react like more aggressively compared to GDP. Uh, okay, now what other observation we can see, except for 2000, uh, this is the only exception when you compare to other things, because we said that no matter which region we are talking about, they always move in the same direction. Although the size might be different, the only deviation is in 2020. We all know what's going on is because economy is doing bad, but government is printing money like no tomorrow. So the housing price go up. But of course, there's a lot of demand as well. Okay, this is very interesting chart. We don't want to look at all these different asset class. A couple of information I want to tell you. So it contains a lot of information. First, these green and blue are the annual returns by different asset class. Okay, if you just look at this from Jan 1, 2020 to December 31st, 2020, it seems like it's okay, not too crazy. But what is blue, dark blue? This dark blue says from the beginning of 2020 to the trough of 2020, how much each asset class lost. Okay, let's just take a look. It's 40%. It's normal, right? So okay, so what is this? Probably 70, right? It's too small on my screen. All right. So what is this dark green says? This dark green says from the lowest point to the highest point in 2020. Okay, this number is even crazier. It's more than 100%. So what does that mean? That means, okay, in 1 year, when you look at the lowest point to the highest point, the range is really wide, all right? Second observation from this chart is that this happened to almost every asset class, except a few exceptions. Although it might not reflect when you just look at the beginning to the end, but during the whole year, the market is crazy, right? So you experience trough, you also experience peak, but you don't know when to get in or when to get out because it's extremely difficult to time the market. It also tells you that you can't bet on one asset. You have to diversify because the, the trough and the peak, they don't happen at the same time. You need to diversify. You cannot predict the market. That's the lessons I want you to learn. Okay. Now let's look at 2021. So when we look at risk, there are two things we look at. It. First is how likely this risk will happen. Second is if that happens, how big is the impact? Of course, we want to like look at this part because that means it's very likely to happen. And once it happens, it has huge impact to us. So what are those events we need to keep an eye on in 2021? We see debt crisis, we see prolonged stagnation, and then we also see asset class bubble burst. Okay. All right. So recently, I attended a lot of real estate conference. Those are all 3-day events, and then I think I attended already 3, 4. So I absorbed a lot of information. So a constant topic is that how do you reset your expectation going forward? Historically, if you invest in real estate in like 5 years ago, the reality is that you always get like a higher than 20%, 25%, sometimes 35% IRR because you are just in a good market cycle. Now, if you subscribe to the deals, you constantly see a lot of sponsors underwrite the deals saying that, okay, I can achieve 15% IRR. However, realistically speaking, the savvy investor at the conference, they said, if a very conservative sponsor can tell you the deal can give you 12% IRR, you should be very, very happy. So this is the inflated number. These are given by like a responsible and conservative sponsors. So it looks like we have to live with it. We're not going to repeat this high IRR. The reality is right now there's no shortage of money. On the contrary, we have shortage of good deals. Too much money is chasing too few good deals. That's why it's so hard to get into good deals. That's the number one experience I had as individual investors. So if you don't believe me, you can take a look at this chart. Basically, that says what is the size of global bond market, global government bond market. You know, those government bond, either it's zero interest rate or negative, yet it's trillions of money invested into it. So there's no shortage of money. There's shortage of good project that can generate high return. Okay, I get it. You paint a picture that economy is suffering, market is volatile, and it deviates from the reality. So the challenge is, as an individual investor, what should I do? Should I invest? Should I not invest? If I invest, how can I invest? All right, I got very, very confused. All right, so what are the options? These are all the options from logic perspective. Okay, you're standing here. You can either do nothing, that's option A. Option B is do something. Okay, what is that something? You have one option, follow the herd, or second option, cherry picking. What does that mean? Okay, now you're standing here. Let's explore this sitting on the sideline and do nothing. The pose, of course, you avoid all the potential loss because you're not investing, right? So what are the cons? Costs are opportunity cost. Okay, let's take a look. If in order to avoid losses, you don't invest in 2009, so how much are you missing? So this table is actually data from 2019. So 10 years back, sorry, can someone mute themselves? Because I can't hear someone talking. All right, so this data actually shows if you didn't invest in 2009, so 10 years, if you don't invest in real estate, invest in S&P, you are missing 300% return in 10-year period. If you didn't invest in real estate, you are missing 330. What's more, every year you are experiencing like close to 2% inflation. So a rough math, 10 years, that's 20%. If you add this up, that will give you 320 to 350% return that you're missing because you are sitting on the sideline. So that's the cost, and that's the benefit. You are avoiding potential loss. So which one is which? It's up to you. Now, so a few things I want to say to people who decided to do nothing. So just to clarify, when I say decide to do nothing, I'm not saying that some people, they actually closely watch the market, but they actually are waiting for a good entry point. Those people are not the people that do nothing. When I say do nothing, is the type of people that feel overwhelmed, so they shut down and they don't want to absorb the information from the market. That's what I mean by do nothing. So a couple of things I want to say to them. So of course there's a risk, but no risk, no reward. Think about those government bonds, right? That there's a reason why you're not getting any interest on those because there's no risk. Okay, so can I wait till everything settles? I would say market timing is very, very hard if it's not impossible. And lastly, this is very important point I want to share with everybody. So think about capital as water flow, right? It has to go somewhere. It cannot be stopped. Okay, so where does those money goes, right? So they have to invest in a certain asset class. So what you want is to find out which asset class are relatively safe. So invest in those asset class. So even though the whole market, the economy is not good, there must be some asset class perform better compared to other asset class. Just found out those. So okay, so now you're standing here. I want to do something, but how? The first one is that I have no idea what to do. I just follow what somebody else is doing. Okay, these are the pictures. If you ever been to Africa, you know what's safari. So basically, every year, so those wildebeest, they need to cross river to go from Kenya to Tanzania, or the other way around. It depends on which season you're talking about. So but this is very, very dangerous to do because there might be crocodile waiting in the river. So how do they do it? They follow the lead. So if the lead decide that day is a good day to cross the river, as long as it costs, then everybody will follow the lead, and then they just jump. Or one day I was watching there, waiting for 2 hours, and the lead decided that day was not a good day. Then they all went back home, right? So they don't have their own independent thoughts, right? So they just follow the lead. Uh, I don't know about you, but that doesn't sound like what I want to be as investors. Um, so why this is relevant? Because one thing I observed in 2020 is that I when this economy shut down, I thought, okay, the market should be bad right now. But I actually received more deals than ever. And among all those deals, I see a lot of new sponsors because they're so eager to get into the space and get their first deal done under their belt, right? And the cap rate keep going down and down and down, right? So it just amazed me that everybody seems to be like having those fear of missing out. But is that the right thing to do just because everybody is doing so? Um, I have a question, right? So, of course, everybody had different opinion, but yeah, I would choose to be on the other camp. Okay, so now, yeah, you want to do the cherry picking. Cherry picking means that you look at different asset class and then you pick the one that you think are relatively safe or can give you relatively high risk-adjusted returns and invest in that asset class, even though you know that the economy is very, very uncertain in the most 1 to 2 years, right? So, okay, if you want to do this part, so now you still have challenges. Depend on like whether you're an experienced investor or new investors. So for the new investors, you might say, I don't know where to find those deals. I don't have access to any deal flow. Okay, a more senior investor will say, I do have access to deal flow, but they all look the same to me. Of course, because all the sponsors, they advertise 15% IRR, almost feel like this is the golden standard now. Okay, so then if one deal is 15%, another deal is 15%, does it mean that they are equally good? Or another deal is 12%, does it mean that the 12% IRR deal is worse than the 15%? How can I tell the good one from the bad ones? right? So that's another struggle. The third struggle, which is more experienced passive investor, they look at a lot of deals, they know the numbers trick, and then they can tell the good one from the bad one, but they struggle to get into the good deals. In reality, what happened is that, okay, you follow a certain operator, you know that he's pretty famous, and then he presented a deal, and then he said that minimum investment is 50K. That's good. You want to invest. Then they tell you, sorry, we are oversubscribed within less than 24 hours. The rule they follow is that, okay, first, the higher amount that you commit, then you are in front of everybody else. Second, whoever wired the money first, the probability of getting in is higher, right? So that's the reality. All right, so now let's talk about all these challenges one by one. For the more junior investors, how do I get access to a deal flow? I would say it's just like everything else, right? So if you want to learn snowboard, you want to snowboard with other experienced boarders, you just need to find out who in your friend circle is a boarder. And then you connect with them, and then you hang out with them, and then ask them, hey, next time if you go on a trip, please invite me, right? So then people have you in mind next time when they have a trip, they invite you. Same thing here, right? You need to find out who are invested in real estate, and then who they invest with, and then you network with them, right? So you can get the list of sponsors by talking to people, reading from books, podcasts, forum, and conference. Conference is very, very effective. And it's even convenient. Right now, you don't have to buy the ticket. You can just Zoom conference. I attended a lot of meetings last year and this year. Okay, the second challenge we talk about is how do we distinguish good deal from bad deals? Okay, because they all look the same. I will change my perspective, like ask myself, how can a deal go bad, right? So there are several several costs a deal can go bad, and they all have solutions. Okay, the first one, I pay the wrong asset class or the wrong region or the wrong strategy to invest in current economy. They don't match, right? Okay, so what is the solution? You need to perform work ethic. He doesn't put investors' interest in front of his own interest. Okay, maybe he doesn't have capability, or he's not experienced enough. He made a mistake, a rookie mistake, right? So what's the solution? You need to perform sponsored due diligence. Okay, the third one, you invested in the wrong deal. This deal doesn't perform as projected because in the underwriting model, the assumptions are too aggressive, or the business plan they propose are unproven, or finance-wise, they over-leverage. Okay, what do? You need to do independent underwriting. Never trust sponsors' pro forma. Okay, sometimes even after all this homework, things can go beyond your control. How can you prevent that from happening? You cannot prevent, you can reduce the probability by diversify. So those are the things that can make a good deal become a bad deal. But if we perform all these things, then we can reduce the probability of a good deal going bad deals. And a lot of things can be done before you even have a deal so that you can tell which are the good one, which are the bad one. For example, in current environment, I probably don't think hotel is one of the asset class that I want to invest, right? So I can also say in current environment, I don't feel comfortable invest in uh, a house in New York, right? It can be, right? And somebody can say, oh, new development or deep value add strategy probably has higher risk in current environment, right? So you can filter down the one that you want to focus and the one that you don't want to focus in current environment. Okay, on this side, you can proactively connecting to sponsors and then talk to them and then perform due diligence and then check their track record. So whoever that pass your vetting process, then you will look at their deal. You don't look at every single deal from nobody, the new sponsors that you don't want to look at every single deal that's from outside of the list of your vetted sponsors, right? So, and then you also diversify. So that's how you can reduce your risk. Okay, so now you found the good deals, you do every homework, but how can I get into the good deal? So the scenario is this: you attended a webinar, an hour of a webinar. So the sponsor described to you a can't miss the opportunity. At the end of the webinar, he calls for action. So he said, please tell me whether you want to commit or not. If yes, enter the amount now. And then it tells you that, okay, the probability of getting in depends on when you wire the money and then how much you invest. So now what do you do? All right. So Henry, can you pull out a poll?
Yeah, I did just launched it. It's just for sort of fun. Mm-hmm. So making this presentation a little more interactive. Mm-hmm. So for free. Okay.
I probably should. Mm-hmm.
Yeah, see the votes are coming in.
Okay.
Yeah.
It's interesting to see like how many people like voting. I can see it real time.
Yeah. You got, yeah, it's real. Can you see it? Or is it just me?
I can actually see it. That's a lot
good.
of fun.
Okay, it's kind of fun, right?
yeah, exactly.
All right. Okay. Let's close the poll at the 60-second mark. Is that good?
Okay. Yep.
Because I know you have a lot of things to go through. This is kind of fun.
All right,
let's end the poll, and we're gonna share the results.
Okay. Can you see the result?
I can. Can everyone see it? Yeah. It's it looks like the majority of the overwhelmingly there's at least 5 of those people would say neither, just skip the opportunity. And second highest goal was to commit a higher amount to make sure I'm ahead of the others, and then only 1 person would just do it by faith. Just do it. Well, let's due diligence.
Yep.
Which is what we would expect, right?
Right. And that's the real experience I have in 2020. And again, I experienced the same thing. I found a lot of shitty deals. I don't want to invest. For the good one, after I finished my analysis, I couldn't get it. Or people tell me, okay, you have to raise your minimum amount, otherwise you can't get it, right? So, but that's actually against my diversification rules, right? So the reason I want to invest is I want to diversify. But if in order to get into one deal, I put a lot of capital in it, I'm actually against my rule, right? So, and to be honest, even a good operator can have bad deals. They happen all the time, right? So do you just invest with somebody just because he's famous? No, you still need to do your own due diligence, all right? So, okay, so we will move on. All right, so I believe we all hope that other than those three options, there's a fourth option, which means we don't have to be forced to make an investment decision. We don't want to force to make an invest decision before we fully understand the deal and under the time pressure, or we never want to invest more than what we are comfortable with, just because I want to secure a spot, right? Um, is it okay to have all, or is it just too much to ask? Is there a way to satisfy all of them? The answer is yes. All right, so now we will enter into this fun part. So basically, this is a real estate investing experience like shopping at Trader Joe's. I know that we are actually a little bit slower than I expected, so I will skip the poll and then I will directly jump into it. All right, so when we shop at Trader Joe's, a lot of people will have similar experience. To be honest, I go there every week, right? So this is my experience. So I um, I think Trader Joe's associate the brand with quality food. And then I also found their information is transparent and also provide a lot of information. And I can find the foods, the goods that I cannot find elsewhere. And it's very diversified and very convenient. I can buy foods and then I can buy also other like a healthcare stuff there. It offers the best product at the best price. So it's a value to me. It also has some education content, and I also feel like I belong to a community. So what does that mean? So quality food. Okay, so how do you trust every single food sold at Trader Joe's? You think um, on average they are quality food because they do have this uh, strict vetting process. So this is the quote from their website. To earn a spot on our shelf, each product is submitted to a rigorous testing panel process in which every single aspect of the quality is investigated in the context of the price that we can offer. If a product is assessed as an outstanding value, it becomes a vital part of Trader Joe's shopping adventure. So every single product on the shelf of Trader Joe's, you know, they all went through this vigorous vetting process. A random food will not appear on their shelf. All right, so because of this vetting process, you trust the quality of the food. Um, Second, it's very transparent and informative. So look at this picture. This is some coffee, right? So the description says this is medium roasted with strawberry and brown sugar taste. Interesting. If there's no such information, I probably wouldn't buy it. But because I like strawberry, I might want to try, right? So this is very interesting. And the description from our website said, by crafting this creative, informative signage to support our customers' understanding of our product. Yes, because you can try every single product, but providing this transparency and this information, it help investor, to help the shopper to make a shopping decision, right? Because now they can imagine what it tastes like. Okay, the third one, access to one of the kind product. So this is somebody's list. It says 10 best comfort food that are only available at Trader Joe's in the fall. All right. So what it says on the website said, hey, these exotic food cannot be found elsewhere. It boasted a one-of-a-kind item that range from blah, blah, blah to blah, blah, blah. And it says, full of unique and interesting product. That's interesting, all right? I know this food cannot be found in Walmart. It's only available in Trader Joe's. And it's interesting to find out, oh, so much interesting food out there, from Indian food to Thai food or to Mexico, you can never imagine, right? Okay, diversify. Look at this. These are all coffee. Even coffee, you have so many to choose from. It's very convenient. As I mentioned, you can buy food, you can buy personal personal care stuff. And what is value? So this is very interesting. So value, okay, this quote I really like. Price is what you pay. Value is what you get. Let's say one day I'm really craving for Indian food. So what choice I have? I can buy a ticket to fly to India to have authentic Indian food, but obviously it's too expensive. Another choice, I can go to Trader Joe's and then found out this best Indian food. All right, so does it cost more than India local market? For sure, but it definitely costs less than buying a ticket and fly there, right? Uh, so what you pay for is maybe $3, $4 for each one of them. Definitely, I would say the price at Trader Joe's is definitely higher than Walmart, for sure. But in Walmart, you can't find this product, for sure. But compared to Whole Food, it's relatively cheaper. That's my impression. And also, I can find more interesting stuff, right? So it says, this is enjoyable and I got great deal. So because of this experience, these customers that I look forward to coming back, right? Okay, education. This is the first time I found out the difference between different type of apple, thanks to Trader Joe's. Okay, community. Every year they have this customer choice awards, right? So the quote I get from the website, family customer service, an affirmative that you belong to a culture informed community of shopper. Yeah, because they provide all this information and education content. In choice of lifestyle, the shopper at Trader Joe's are the people who care about their well-being versus the shopper at Walmart. They're more sensitive to price. Full of discovery and fun. Blah blah, and then go shopping again and again because of this experience. Okay, so what does that relate to our real estate investing? What if we can create a similar product? Here are the reason that I do the comparison. Okay, if we can find a service that can vet the operators, can only present the deals from the top operators, wouldn't it be helpful? Okay, when every deal that gets presented, if someone can do the risk reward independent analysis for you, wouldn't that be helpful to help you to make your own investment decision? Okay, and remember that we struggle to get into a good deal either because of the time pressure or the capital pressure, because you have to commit a lot in order to get in, but you don't want to do that because you want to diversify your portfolio. So now, if a service can tell you that I can guarantee you getting into the good deal at the reasonable capital commitment, and it offers you a diversified portfolio. Why it offers diversified portfolio? Because you don't have to commit a higher amount in one deal, you can spare the capital into other deals. And it's very convenient because somebody else does all the analysis for you. You make your decision and then you invest passively. And then we will talk about what's the value and then what's the cost on that. Of course, it comes with education and then also the community of savvy investors. Okay, so we talked about this vetting process. The vetting process, first, you need to know who are actively doing deals, and then you pre-screening, and then you interview them. You use paid service to do due diligence. Those are very expensive service. I don't think that as individual investors, if you are doing deal by deal basis, you can afford to do that. But if we do the co-investing because of this economies scale, we can do that. And then also talk to other investors. These are very, very time consuming, but together we can afford to do that. And then lastly, we want to get on the early bird list of these vetted sponsors. So next time when they have a deal, they will inform us earlier so that we have the time to do the underwriting. The second benefit we talk about is give you a clear picture. What is the reward and risk look like so that you can make a decision. This is very important because it shows you, because we are investing together, our interests are aligned. So I won't get into a deal because I don't get compensated by bringing capital to some random sponsors. I only invest in the deal that I think is safe, prudent, and then can give me a higher risk-adjusted return, right? So this is very, very important. And then we also said that we can provide this independent underwriting by looking all these different aspects. The end result is that I will tell you for this deal, what is the upside? What is the downside? And then you will consider your own situation and then decide whether this is an opportunity for you or not. You don't have any pressure to make a decision on the spot without understanding what you are getting into. Okay, this one is the one that I mentioned again and again and again. How do you get access to a good deal? Otherwise, it's not available to you. So how do we do it? We do it by investing together, and then we commit to a large amount of capital as a group. But individual, you actually get access to a good deal and guarantee access to a good deal at the lower minimum investment. So that alone, I think it's worth exploring, because this is the biggest frustration I have. And then diversification, right? So I don't think I need to go through all this because savvy investors, they all know that you cannot predict the future. You can only predict with probability. So different asset class, they behave differently. Imagine this is one asset class. This is another. If you invest in both, what you get is this green line. So now you reduce your volatility. Okay, convenience. This is a one-stop investing experience. What's inside the package is all the aspects I talk about to reduce the probability of investing in a bad deal or cannot investing in a good deal, right? So this is what you get inside this box. And then look at this smiley face. Okay, the value. The value is the difference between what you get inside this box versus what you get as an individual investor. Either you cannot get in, or you invested in the wrong deal, or you are sitting at the sideline. What is the price you pay for it? Yes, you will pay a small performance-based fee. What does that mean? That means I won't get paid regardless how much money I bring in. I can bring in just one investors, or I can bring in 100 investors, but none of them matters because I don't get paid by the capital I bring in. I only get paid when the deal is a good deal. If perform, then I get a small percentage of the return. If the deal goes south, I don't get paid because I made a bad judgment call, right? Okay, this is interesting part. Your net return not necessarily be lower compared to if you can invest as an individual investor. This is because we think about this as a Groupon. If you invest in large amount, you can negotiate a better term. I have a spreadsheet to show you an example, but this is not guaranteed. The more investor we bring along, the bigger of this co-investing group, then we will have a higher negotiation power. So I think this is icing in the cake, but getting access to a good deal without committing too much money, that I think is the biggest benefit. Of course, you subscribe to my weekly email, and then we also do a lot of webinars. And then on our website, we also have those evergreen topic. And plus, when the deal comes, I will offer this independent underwriting. And welcome to the club. You grow, you learn, you share resource, you network with other savvy investors. All right, so it's we still have 8 minutes. So everybody, welcome to ask any questions that you have.
Yeah, while we're waiting for questions, thank you very much for a great presentation. I also wanted to add the community portion because I think that's what Coast-to-Coast stands for. I think a lot of us, we actually had in previous time, we were underwriting a deal, almost like discussing about the deal because someone might have a different background, or like you work in Wall Street, you will understand the financial of it. Someone might actually local to the state or the city, they could bring in that aspect of it. So, you know, not only that we're investing together, but potentially, but we're also sharing knowledge and resources in a way that is going to be mutually beneficial.
Exactly.
So I really like that aspect of it.
Right, and I really found that in real estate investing cycle, I just feel like people are very willing to share because the more you share, you don't lose your wealth, right? So you just make more friends, and then other people will tell you. Yesterday, I talked to another investor. He told me that he is very actively growing his passive portfolio as me, but he just went to another extreme. He basically networked with 300 investors last year. But that's his full-time job, basically. Yeah.
Wow.
So, yeah.
It does take a lot of commitment to do that.
Exactly.
Yeah.
Exactly.
So, I think there's a question that I would ask too is if I know one of the minimum investment requirement is at least 50, and now I think it's maybe the 75,000 for some of the even more well-known sponsor. So are you saying that an investor could put in less than the required amount? Potentially, if we were able to co-invest together.
Yes, I think definitely yes. The caveat is this. So when we say minimum amount, you have to distinguish. There are two minimum amounts. One is the so-called notional minimum amount. Let's say I attended a webinar. On the deck, they said minimum amount is 50K. But if you invest in 50K, I guarantee you cannot get in if it's a good deal. So what is the like a realistic minimum amount in order to guarantee you to get in? If that is our benchmark to compare, right? So what I can say, if that's a good deal, that amount probably is 100K. But through co-investing, you can invest into a good deal in maybe 50K or even less than that. So it's definitely less than if you invest as individual investor, like a 100K. That's for sure.
Great, thanks. So we do have a question from the audience. Jay Park asked a question, and his question is the interest rate increasing? Then is it a good time for real estate investment?
He said if the interest rate is rising, whether it's a good time for a real estate investment? Is that the right question?
Yeah, I don't think it's if, I think it's more a statement, more a question. Do you see that interest rate is rising? And if so, is it a good time to still invest in real estate?
So of course, everybody has different opinion. I would say that I forecast for the next 2 years, interest rate will stay low. And within 5 years, it could be the same level or even lower. I don't see it will rise, but I could be wrong. That's first about the direction of interest rate. Second, if interest rate go high, think about it. If you are a home buyer, right? So your mortgage rate will go up. That means less people can afford to buy it. It's bad for the real estate investment. The rate goes lower, more people will buy because you can't afford to buy it.
So I guess right now the rate is pretty low, so that's why the whole real estate market is so hot right now.
Exactly.
So it could be. It looks like it's still a good time, I think. And then we have another question came in from Jinsho Yu, and his question is, this is essentially pulling money together and buy properties.
Exactly. Pulling money together to negotiate a better term for us to get in, either by lower the minimum amount or by guarantee us to getting a good deal. And also through other like underwriting service, because we do a lot of vetting upfront. We only invest into sponsors that we vet. We won't invest in any random sponsors.
Right, so I think we are investing in a successful, someone with good track record and into their deals that they're buying property. So we ourselves are not, or at least in this case, for your co-investing strategy, Yan, is not to buy directly.
Yeah.
Okay. All right. And also another follow-up on question.
Do not invest in like just. Sorry.
His question is. So there's a follow-on question from Jinsho, and the question is, so why you commit $50,000 or commit $100,000 has a difference? So I think the question is
the difference is that, of course, if you have a limited amount of capital, 100K is not an issue to you, then whatever, right? So you can make whatever decision you have. But for most of the people, when capital is limited, they want to diversify across more deals, because you put all your eggs into one deal, then what if it goes south, right? So I do see very famous sponsors. Most of the time they have good results, but I also see some other deals go south, right? So would you just invest in somebody because he's famous? No, right? So you still want to do due diligence into every single deal. You don't want to put all your money into one deal.
Right. I think there's also a reason, because of the sponsors who are running these deals. They want to have the least amount of investors with the most amount of capital. So they have less basically people they have to talk to send, get paperwork done or to send you K1. So I think that's definitely a benefit to the sponsor side where they want to keep the minimum amount. And when there's high demand, then the ones who are committing more capital get into the deal. I think that's the difference. And I think again, you try to bridge that gap by basically forming a pool, co-investing together, so you can commit a bigger piece of capital than any one person will want to commit.
Exactly. So basically, we take over the headache the sponsor don't want to deal with by handling with individual investors, but we also provide value to our individual investors by guaranteed to get into the good deals. Yeah, so it's actually just finding a niche, like solving these demands from individual investors. Any other questions?
Yeah, any other questions for free? Oh, we do just right on time. We have a Jareen has a question. How many deals is one's investment spread over if they invest with you?
Say that again.
I'm going to repeat the question. I think how many deals is one person's investment is being spread out if they invest with you? Like maybe it's spreading out across multiple deals, or how do you envision it works?
Okay, so I try to understand this question. I think what she's asking is that how exactly the portfolio is diversified, right? So I think there are two ways to diversify. Okay, let me see. I do think that I have some Q&A here. Okay, so yeah, I hope this is the question that you ask. So there are two ways to diversify. One is you diversify at the deal level, meaning, okay, these are the investors, right? So co-investing, right? So these are individual deals, right? So you can see they are different asset class. So for each asset class, we have a fund of fund, like multifamily, self-storage, senior living, and you invest into each fund. So the diversification is at this level, right? So that's one way to do it. Another way to do it, people call it blind pool. So it's at the fund level. So you invest into this fund of fund. This fund of fund invests into multi-asset, right? So we can do both, but the requirement is different. So if you move from this model on the left-hand side to the right-hand side, it requires higher trust from investor to this fund of fund manager, because when you diversify, it's no longer like you can see all the information from each specific deal. Everything is blind together. That's how you achieve the diversification, right? So that's why the fund manager need to have high level of trust from investor that can do the good thing for them in order to do this model. It also has higher requirement for fund of fund manager because you need to have multiple opportunities waiting for you to invest. Imagine that investor give you the money, but you only have one deal. Other deals are not lined up. Then the money that investor give you are just waiting and not earning any return, right? So these definitely need to have a pool of opportunities waiting there. It has higher requirement for sure. But if there are opportunities lining up, these also have benefit. The benefit is that with so much money here, it can easily get into good deal because we don't need to raise money. So here, what happened is that we found out there's a good opportunity. we do a webinar and investor give us money. So you can see, okay, that takes some time, right? So, and another opportunity show up, it takes some time. Another opportunity shows up, it takes some time. But this one, because the money is here, we can quickly deploy the capital. So there's pros and cons for sure. So hopefully this answers your questions.
So I think are you operating more closer to the or maybe you intend to work on the one to the left? So
yeah, to the left. Right.
So you can achieve diversification by investing in individual funds of funds. And it's going to be kind of deal per deal basis. So they're not being spread over like you buy a mutual fund.
Right. And also this provides investors more transparency, because I can tell you what is the cash flow from this deal, what is the cash flow from this deal, what is the cash flow from this deal, right? And you can also choose, for example, an investor, he likes multifamily, he likes senior living, but he doesn't like self-storage. Okay, you can all out, right? So you only choose to invest into the opportunities that you believe in here. The decision is at fund of fund manager level. You don't get to choose. I can describe to you, okay, what is the characteristics, what are the asset class that I will be investing in, but you cannot say, hey, I want to opt out of this self-storage. So this is actually more advanced, like in the future. But at the beginning, we will start from this one.
Okay. Hopefully that answers your question, Javine. If not, feel free to put up another question to clarify. We do have another question from Vivek. And Vivek asks, what asset classes is the co-investing group planning to invest in?
That's a good question. Right. That's a good question. So my focus, given that right now there's a lot of uncertainty, I will prefer the ones that's more recession resistant, right? So multifamily and then self-storage, but self-storage you have to be very, very careful because I do see overbuilding in self-storage space. Senior living, given the condition that you have to find a good operator because that actually expose, if you don't have a good, when I say operator, I actually mean the PM, right? So if the property manager is not doing a great job, the residents there will have higher exposure to COVID. So then your return will be messed up, right? So there's opportunity just because every day there is more than 100,000 people grow older than 65 years old, right? So that's the tailwind. You have to ride this long-term trend, but you also need to be aware of the short-term headwind, which is if you don't manage your community well, your residency might get COVID, and then it screwed up your NOI and then also the value of your property. Those some of the things, and I'm also thinking other more alternative assets, which you will see in April. Yeah.
Okay. There's a cliffhanger there, so look forward to hearing more from you about that. We do. I guess the second question from Vivek, I think you might have already answered to, is also could you add some light into the structure of the deal for co-investing? I guess is that kind of answered here, or maybe there's something more to it.
The structure?
Let's see. Yeah, go ahead.
Sorry, what do you want to say?
Yeah, I'm thinking it may have to do with by investing in a co-investing deal, is there maybe a fee structure, or is there a equity split level, or anything like that?
Okay. So I don't know what you specifically mean, but I will show you what does the structure look like. So on the right-hand side, this is the fund of fund. Basically, a group of investors invest into this fund of fund. We also call it SPV. SPV means special purpose vehicle. the only purpose of this vehicle is investing into other people's deal, right? So then when we invest, if you can draw a line here, we are LP into this deal because we cannot control anything. We are just a limited partner. We are passive investors. And within this fund of fund, there's fund of fund manager, and then also there are individual investor of this fund of fund. So that's the structure. And then when we talk about fees, there's, I think I also have an example to show that sometimes people think that, okay, looks like you are a second layer here. Would that means that I can actually get worse return compared to if I can get in to invest with directly with the sponsor? So, okay, so I would think when you do the comparison, make sure that you are doing the apple to apple comparison. So, for example, if you knew the sponsor already, okay, and you knew that he had a good track record, then okay, can you do some research about whether this is a good deal or not? So that's on you. Second, can you guarantee to get in? Third, I want to show you through this example, sometimes you can get better terms by investing through co-investing, even though you can invest directly. Okay, so what does this example look like? At the deal level, let's say it offers you 22% IRR. And if you invest as individual investor, assuming you can get in, assuming you've done all your due diligence and then research, okay, what is the term that the sponsor offer? Pref at 8%, and then 60-40 split beyond the pref. Okay, so what do you get? You get 8% because that's a pref, plus 22 subtract the 8%. Everything above this, you get 60%. So at the end, you get 16.4. But sponsors, because they want to deal with less investors, so they offer a better term for fund of fund. As an entity, we get 8% pref and then 70-30 split. So now at the fund level, what do we get? We get everything being equal, replace the 60% to 70%, you get 17.8. Okay, now at the fund level, remember we said there is an investor and the manager, right? So let's say we said, okay, this is still 8% pref. And then everything beyond that, that's 90-10 split. 90% goes to investor, 10% goes to the manager. Okay, so how much the investor get net of everything? Okay, you have 8% pref plus, remember SPV get 17.8%. Subtract the 8% pref, multiply by 90% split, you get 16.82. The manager get less than 1%. Okay, you see this 16.82 is what your net IRR if you invest through co-investing group. If you invest directly to the sponsor, you get 16.4. Not to mention, you have to spend time to do your own research and make sure that you can get in. So sometimes investing through co-investing can get better terms. So this is an example. Does it make sense?
Yeah, I think it definitely helps. I think in this example, you're showing because they are investing, maybe get negotiated better terms. Like I think you mentioned a Groupon strategy,
Exactly.
and the benefit to the sponsor is they can raise a larger amount of capital. So they have the incentive to do it this way, so they don't have to manage 10 investors unless they only have to manage one investor as a group. So,
yeah, and I actually see more and more sponsors open to this one, this model.
I have seen quite a few more sponsors are opening to this model too. So
yeah.
I think someone raised a hand. I think it was Sung Tao. Did you raise your hand, or you want to just type in your questions at the in the Q&A? Let me know if you want to speak. Okay, I'm actually going to say allow you to talk. If you have any questions, just feel free to ask your question right now, or unmute yourself. But with that, we are getting actually right at 6:15. So it is at the end of it. Any other questions from the audience? You guys have been very patient, and Yan has done a fabulous job of this presentation. So where can we? So this webinar will be recorded and will be sent to everybody who registered today. With that said, I think they'll be looking forward to future content and education materials from you, Yan. It's always great calling you webinars. And thank you everybody for attending this this Coast to Coast meetup. We'll see you again very soon.
So this, you can find out our contact information, Coast to Coast. So go to the Facebook group, and then want to learn more about this co-investing group, go to sharpeinvestorgroup.com. And then if you want to schedule a call with me, you just go to the website /contact, or you can subscribe to our weekly newsletter as well. And these are our emails. All right, thank you guys. Have a good night.
All right. Thanks, everybody. Have a good night.
Thank you. Bye.
Bye.
Are you done with the recording, or should I hit stop?